lot of people on the call and a lot more that are going to be popping in here in a few minutes. So kind of slow it down and wait for people to get on. While we're here, I want to introduce my team. You can't see them, but they are here in the background like always. We have Annalise in Corvallis, Heidi in Albany. Our newest member to our team we're super excited about is Riley. So she's kind of amazing. You'll see her around. She's adorable. You guys will love her. Kelly and Cinda and Katrina and myself. So we're your sales team for the Willamette Valley. If any of you need any help with tools, programs, prospecting, make sure to reach out to one of us. I want to remind people about HomeBot. It's an amazing tool that is really, really good at helping you stay in touch with your sphere and getting new listings from it. So I'm surprised at how many people I talk to that have not heard about it because it's an amazing program. So please reach out to one of us and we would love to chat with you about that. We obviously need to figure out some ways to get some more listings right now. So, and go get gas apparently. And I think Walt's going to tell us about that. I went to Costco yesterday and the line was all the way through Costco, all the way to 22. Crazy. And it went up 10 cents since Sunday. So yay, super excited. Let's all work from home. Okay, I'm sorry. All right, well, take it away.
Perfect. So yeah, we are going to talk a little bit about gas today. And my camera froze up again. Hold on 1 second. So.
And I am going to be checking everybody into our computer to get your CE going out while Walt gets unfrozen there. I'm going to be loading you into our program. You'll get a certificate this afternoon or in the morning in your email box. We are recording it. So if you'd like a copy of that, we'll be happy to get that to you also. If you have any questions, just put it in the chat. And if Walt doesn't cover it first, we will go over the different questions. Oh, Walt, where are you? Anyhow,
almost back. Here we go. I'm sure it's going to freeze up again. So, but that's okay. So yeah, so Tracy, if you could watch the chat for me and then just pop on, I'm going to share my screen. We're going to talk about gas prices today. And you know, really yesterday, as I was really finalizing this course, let me actually back up first. Thank you, Tracy, for having us. I'm a little off because my camera keeps freezing. So, so thank you so much. It's been a little while since we've had one of these. And Tracy came and said, "Hey, Walt, when are we going to do another lunch and learn?" And
taking a nap.
Yeah, and you know, this course really, I look at this course really similar to ones that we had done really when COVID hit, guys, where we really needed to be the voice of reason for our clients, the voice of calm for our clients. We kind of get in our own little worlds. At least I get in my own little world, and I don't really realize how nervous everybody is out there. And it's getting worse. And so let me go through these things. So today I kind of geeked out the last couple of days and pulled a lot of data. So we're going to go over a lot of data. This data you can share with your clients. We'll give you the slide deck so that way you can share this all with your clients. And it's not meant to scare anybody, because really I think that there's some really good things coming. But it's kind of like working out. And you all can tell that, you know, I'm a very robust individual, work out every day, just joking. But, you know, as you work out, you have that pain, right? But you're getting to something much better. And we're going to have some pain. We're going to have some pain here in the next 6 months to a year into something much better. And I think where we're heading, I am super excited about where we're heading. But we've got to go through that pain. So let me explain. So here is, let me get rid of that. Let me go and share my screen, share my slide show. from the beginning. All right, so you should see my slideshow now, right? Perfect. So again, be the voice of reason to your clients. So today we're going to talk really about the three biggest issues that we have in real estate right now, which I believe are the three biggest issues, which is inflation, interest rates, and inventory. Homeownership really acts as a hedge against inflation. So what is a hedge? We're always talking about a hedge. We're in the mortgage industry, we hedge our funds, and so I just want to give you guys the definition of really what a hedge is. A hedge is an investment that is made with an intention of reducing the risk of an adverse price movement in an asset. So simply stated, real estate is a one-time honored inflation hedge. It's a tangible asset, and those tend to hold their value during inflationary times, unlike paper assets. More specifically, as prices rise, so do property values. That is historical data. And that was from Mark Kusin, financial writer for Investopia. Here, as we look at really, again, home ownership as a hedge against inflation, this was from the National Association of Realtors, CoreLogic, and Consumer Price Index. We look at home price appreciation. Here in 2021, it's anticipated that we're going to have really about an 18% price appreciation this year. Last year it was around 18% nationwide. The year before, in 2020, we're around 9.2%. Inflation at that time, as we were going through COVID, was 1.4%. Now we have inflation at 6.8% at the end of 2021. Currently, inflation, the inflation rate is 7.3%, but still home prices, you'll notice, are all going up. If we think back to the times of the 80s, I always hear this, interest rates were 18, 19, 20% in the 80s. Yes, that's high. And that's much higher than any of us, I think, have seen. At least I've never seen interest rates that high. I started the business in 1998. And so with that, even though interest rates were high at that time, you could go into a bank and you could get a bond, one of the safest investments out there, for equal to that interest rate. You could get it at 16, 18, 20%. Inflation kind of works as the same way. Inflation and house prices. House prices typically will be higher than what inflation is. And as we look throughout the 70s, 80s, 90s, 2000s, 2010, as we go throughout this period of time, 70s, again, as we test this theory, home price appreciation, 9.9%, inflation, 7.1%. The 80s, we were pretty much deadlocked there, right at 5.5 and 5.6. The 90s, 4% and 3%. 2000s, again, really darn close to each other. But then as we head into 2010, we had 4.9% appreciation, 1.8 inflation, 2020 and 2021. So more than not, home price appreciation outweighs inflation, and it acts as that hedge. A fixed rate mortgage allows you to maintain the biggest portion of housing expenses the same payment. Sure, property taxes will rise and other expenses may creep up, but your monthly housing payment remains the same. That's certainly not the case if you're renting. Now, as we look at inflation, core inflation compared to rental price appreciation, and this should help you get your renters off the fence into a house, because we know that house prices are going to rise consistently during inflation. What's also going to rise consistently and will most likely outpace inflation are rents. So as we look at rents, you can see here more than not over the last, this chart, I believe, went back to 1970 as well. Yeah, 1973 to 2020. Here you can see we have more green above the blue. The blue is core inflation, and the rental price appreciation has been higher than what core inflation typically is. So that tells us that a renter wants to get out of renting, needs to get into purchasing a home where it's going to be a little bit safer as we head into a more inflationary time. Homeowners are shielded from mounting rental prices because their cost is fixed, regardless of what's happening in the market. Tangible assets like real estate get more valuable over time, which makes buying a home a good way to spend your money during inflationary times. Again, a fixed asset is much better than other assets that are not fixed. If you have cash or are expecting inflation, you want to think through where you put your money so you do not lose value. Housing is commonly looked at as a good inflation hedge, especially with interest rates being so low. There's also a couple of other areas, we'll talk more about this in a little bit, a couple other areas that do really well during highly inflationary times. That would be commodities such as gold, silver, and now crypto. We're not going to talk a lot about crypto today, but we're starting to see money go into crypto as well. Here is we're looking at, this was in 2021 Q4, the home price expectation survey. The optimists that were surveyed, or out of everybody that was surveyed, the optimist said that 62.5% of them, let me see here. I don't remember this slide, I'm sorry. Cumulative house appreciation by 2026. Basically, house appreciation is going to rise. The optimist said that there were 62.5% of them that said that house prices are going to rise consistently by the year 2026. The pessimist, 23% of them still said that house prices are going to rise. And in the overall group that was surveyed, 43% believes that house prices are going to rise. So as we look at house prices rising, we also know that in inflationary times, potentially a recession hits. And there's already word of the recession coming. So when does the recession hit and what does that mean for us? Well, as we look at really inflationary times and recessions, these dark lines here are all recessions since 1960. And as you look, you can see that really during that period of time, house prices consistently rose during recessions. There was really, it's pretty rare that house prices don't rise. We do look at 2008, but you can see that really we had a little bit of a blip there during that period of time. And 2008 was much more than just a recession. It was a great recession, but we really had a housing collapse. We had a lot of other things that happened during that period of time. Housing collapse, bank collapse. We had a lot of things happening. Of course, you guys know this. But during all other times, and even after 2008, we saw home prices really start to increase. We took a dip down, and then really home prices started to increase. So again, we're looking at even during a recession, home prices increase in value. So let's chat a little bit about mortgage rates. What does this mean for mortgage rates? And if we have any questions, just ask away. So February 3rd, 2022, interest rates, the average rate, according to Freddie Mac, was about 3.55%. And that was February 3rd. Right now we're pushing 4%. And on a 15-year, you're still below 3 at that time. Now you're above 3. But ultimately, that's where rates were just a month ago. As we look at really the history of rates since 2020, right before COVID hit, we're really at that 3.75 range right now. Again, now this is a month old at this point, but if we look at today's rates, we're now above where we were when COVID hit, before we had all those issues. And at that time, we were heading into a recession as well. And what did house prices do during that period of time? As mortgage rates rise, we do expect some moderation in housing demand, causing house price growth to temper. And this is the chief economist for Freddie Mac. So they're stating that house prices are going to start to temper a little bit. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive. So we know that we need house prices to temper a little bit. That doesn't mean a bubble. That does not mean that we're going to slide backwards. That doesn't mean depreciation. That just means that the appreciation that we've seen at that 18, 20% is going to temper a little bit, and it's going to slow down a little bit. That's important. He also went on to say in 2022, we expect purchase originations to grow from 1.2 trillion. Sorry, I've got allergies. 1.2 trillion in 2021 to 2.1 trillion in 2022. While refinances are expected to decrease from 2.7 trillion down to 1.2 trillion. Probably why you have more lenders potentially reaching out to you these days. But ultimately, we see that the purchase market is going to stay strong in 2022 and actually increase in 2022. Here we're looking at interest rates since 1970s, and we're still even pushing 4% right now. We are still below levels of where we were from the 70s, the 80s, the 90s, 2000s. And I got in the business again in 1998. Interest rates were 6% or so at that time. I remember interest rates starting to rise. I remember interest rates being up at the 7%, 8%. I thought the world was over at that point. And then, of course, interest rates started going down, and I never thought that they would hit where they were. So as we look at this, really a key indicator that you guys want to watch, and this is something that would be really important to share with your clients. A key indicator of where rates are headed and where they are would be your 10-year treasury. So since 2021, December 2021, you can see that the 10-year treasury has been on an upward trajectory, meaning rates have been getting worse. They've been getting worse at a pretty rapid rate. As we look at the relationship between the 10-year treasury and the 30-year fixed rate, you'll see that they really mirror each other pretty darn close. And here, as you know, we had in 2021, this was the end of 2021, we were at 10-year treasury rates that were below 2, and our interest rate was about 2.5. Actually, in December 2021, we're about 3.25. But of course, you know, through COVID, we were hitting down in the 2s, 2.5, 2.75 in there. So really watch that 10-year treasury, because this again is the indicator of where rates are headed, and what we're looking at. Now, I want to talk a little bit about the Fed funds rate. So on the 16th, the Fed is going to speak, and let me see if my camera will unfreeze again. Okay, so on the 16th, the Fed is going to speak, and they're likely to raise the Fed funds rate by 0.25%. The market was ready for 0.5%, but that didn't happen. It looks like that the Fed, in their speaking to Congress last week, they've decided that they're going to raise the Fed funds rate 0.25%. We'll find out what happens here when they speak on the 16th, but that's really what's anticipated to happen. Now, this is really a chart showing where economists believe the Fed funds rate is going to head to. So here it looks like that we're going to have roughly JP Morgan Chase. They believe that we're going to have 0.25% increase in the Fed funds rate on the, I believe it's the 16th, but anyway, they said the 22nd. We have in May another Fed meeting. They're believing that we're going to get another 25 basis point hit, another 25 basis point in June, 25 basis point in July, and we'll be at 1.7 or 170 basis points higher by December of 2022, by the end of this year. So what does that mean? When the Fed increases the Fed funds rate, what does that mean? Now, to many of your clients, they're going to believe that they're increasing interest rates, that they are increasing mortgage interest rates. And that simply is not the case. That's a good misnomer of what people believe the Fed funds rate is. The Fed funds rate is simply the rate at which the Fed charges banks. There's 5 banks that they can borrow money from the Fed. They charge those 5 banks those funds. So here in March, they're going to start charging 0.25%. In May, 0.5%, so on and so forth. Those 5 banks then lend money to the rest of the banks in the US. Now, with the Fed funds rate, banks do charge a premium when they're lending out that money. And so when they're starting to lend out the money to us, when it's getting to the general population, they're lending money based upon prime lending. So, and prime lending is 3% above the Fed funds rate. That's the easy way to do that. Now, why does the Fed raise the Fed funds rate? Remember, the Fed's really purpose, their goal, their purpose, really the one job that they have, and that is to kill inflation. Because as we've seen over the last several months, as the Fed has started to talk more about inflation, inflationary fears, inflationary pressure, they started doing this back in November. Interest rates have gotten worse since then. Inflation is a killer on mortgage-backed securities. It's a killer on interest rates, mortgage interest rates. So people will take their money out of the bond market, which keeps our rates low, and they will start investing in other areas, commodities, the stock market, and other areas. Inflation could be good for businesses because they could be more profitable. Inflation is bad for everybody else. Our goods and services cost more, which means it takes more money out of our pocket, which means we can't spend as much. So as the Fed starts to raise the Fed funds rate, they're trying to slow spending down, because what's causing that inflation is we're spending too much money. And so this is on a very 30,000 altitude look down. So we're spending a lot of money, and the Fed starts to slow our spending down. As they raise the Fed funds rate, that slows our spending down. As that happens, the fear is that we can go into deflation, we could go into stagflation, a lot of other inflations, but ultimately it is to slow the economy down. And then as they've slowed the economy down enough, they will start to lower the Fed funds rate and spark the economy and start that realm. So it's anticipated that really we're going to be at around 1.75% for a Fed funds rate as we hit December of this year, according to JP Morgan. Now, let's talk a little bit about oil. Tracy talked about gas prices just a little bit ago. Go get gas. And so we're already seeing gas prices in the high 4s, if not in the 5s at this point. And we're seeing reports of gas in the $6 range. I'm hearing reports from different economists that there's a good likelihood that gas is going to hit $7 a gallon. And so as we look at that, this is a temporary thing. They'll get it figured out. I'm confident that the powers that be will get it figured out. It's going to be a little painful for a little bit. But here's what Steiner wrote. He said that there have been 12 recessions since 1946. 8 have followed major oil price shocks, while further 3 occurred immediately following more modest but still notable oil price run-ups. Now, as we look with that, we also see that we know that crude oil hit $130 a barrel yesterday. Midday, we're down to around $117 a barrel. But ultimately, that's the highest that we've seen crude oil since 2008. And that is really in response to everything that's going on within Russia at this point. Of course, oil is also a supply and demand issue, just like housing is. And with that, we've got crude oil inventories low. We've got crude oil prices high. So it becomes really a supply and demand issue. And the less supply that we have, the higher the cost. Now, if we go back to oil during 1973 and 74, remember that everything that we do repeats itself. There are cycles for everything. 2008 was actually predicted long before 2008. There was a cycle that we were going to head into that recession at that time, and then it was going to be a major recession. We didn't know exactly what it is. There's actually a recession that is heading our way right now. That is a cycle, and so of course war can help push that recession a little bit quicker. But we've got a lot of things that are kind of hitting us at once. So we've got oil. Now, if we look back again, 1973, 74, what were the things that did really well during the recession of that time? And as we had a lot of oil issues at that time, of course, oil did well. We had commodities that did well. Copper did well. Palladium just had an all-time high yesterday. If you were buying palladium, real estate does well. Again, real estate is that hedge against inflation. We also have supply chain issues. Now, as we look at really supply chain issues at this point, as of 2/28, we were a number 8 being fully bottlenecked within our supply chain issues. No surprise to anybody at this point. It's very interesting. I had heard the other day, I think it was last week actually, as I was listening to the radio, I had heard on CNBC that the average time to ship before COVID was 15 days across the US. And as I pulled this chart up, during that period of time, it cost roughly $500 to $1,000 to ship a container across the US or across the world, not the US, but across the world. It cost $500 to $1,000 to ship a container, and it would get here in 15 days. You could ship all the way across the world in 15 days. Boggles my mind you can get across the world that fast, but 15 days. Now we're looking anywhere from 100 to 120 days. On the high side, it was around 150 days. Now, what's happened is, again, supply and demand. As we've had the demand, the cost to ship has gone up exuberantly. We're at really about $4,500 a container. Hence, inflation's hitting harder because it's costing manufacturers more money to ship, and it just all runs downhill into our pocketbooks at that point. We've also got something else that that you guys may have heard of, may not have heard of, but the AN-225 plane that the Ukraine had, Miria, I don't know why I can't say that word right now. Anyway, the plane, this was a massive plane. I don't know if you guys heard about this or not. So this was a massive plane. It used to hold the space shuttle. They would be able to get major jet engines across the world with this plane. It would do humanitarian flights. Nations would be able to send a lot of food one area or the other. There were things that you could fit in this plane that you can't fit in any other plane. There was only one built, and it was the largest plane in the nation. So this plane was destroyed with the current war right now between Russia and the Ukraine. You already have 36 different nations that no longer can fly over Russia's airspace now. You've got the plane that was destroyed that's going to have issues upon supply chain issues. Yeah, so you've got that coming on board as well with supply chain. So just kind of a perfect financial war going on right now, if you will. Now, as we look at war and recession, as we go back to 1957, again, these highlighted spots here are all recessions. And as we look at each recession, as we look at each war, rates had gone down after each recession or each war or a crisis. I mean, here was the oil crisis of 1981, savings and loan crisis, the market crash, I mean, all of this. You've got in 2000, you've got the recession there, you've got the credit crisis, interest rates have gone down. So again, as we have war, as we have negative news in the economy, that has a tendency to then lower our rates. Now, the reason why I share that with you, let me back up here. So really the market over the last 4 months, you can see has gotten worse, consistently worse. We know that rates have gotten worse. But with all of that, really, a recession is imminent. It is coming. And what does a recession mean really to our interest rates? It means that interest rates are going to get better. Now, they're going to get worse first. But the economists that I'm listening to are saying that a recession could be in the next 1 year or less, could be as much as 2 years out, but most likely it's really in the next year. And it could start here at the end of this year, first of next year. We've got war will push us into the recession. We've got inflation as they're hiking the Fed funds rate. That will push us into a recession. Oil will push us into a recession. All of these things will push us into a recession. As we go into a recession, again, values have a tendency to increase. And during that period of time, interest rates have a tendency to decrease. And really housing will be that one thing, again, that will pull us out of the recession, that will then start to help the economy. This is something, so with that, the question is okay, do we wait to buy when rates are better? Do we buy now? What do we do? So here's rates 4 months ago, rates now, and then rates potentially in 6 months from now. Now here, if we're looking at a $450,000 purchase price, putting 10% down, your rate was roughly 2.75% just in November. Rates have gone up again considerably, a full point. Today, we're at roughly 3.75, 3.875 in there. Depending upon credit, you're going to be over 4. If your credit's a little harsher in that, depending upon what type of loan you're doing. But we're going to be right in that ballpark. Now, where we're heading to is rates are most likely going to be hitting 4.5, 4.75 within the next 6 months. That's really what economists have been calling for. We're going to stay below 5, but ultimately 4.5, 4.75. As we look at that, your payment is going to be $2,100 for that same loan that you could have gotten just really at that point, it would be 10 months ago for roughly $1,653. So clients are going to be paying another $459 during that period of time. Now, if you wait, the other thing is then, and I talked about this in another slide, the other thing is that house prices are going to increase during that period of time. So don't wait. We know that interest rates are going to be lower. Economists I'm listening to are potentially talking about rates being as low as they were just 6 months ago, a year ago, if not lower. But we don't want to hang our hat on that. Too many people hung their hat on that type of news in 2008. You could just refinance. You can go do an adjustable, just refinance. We don't want to hang our hat on that. The thing is buy now, so you've got that hedge against inflation. Now, as we look at inventory, we know that inventory in Oregon is down. Sorry about that. I had a phone call coming in and thought I'd canceled that. Anyway, so we have inventory that's down a little bit here in Oregon right now, 0.7%. So not a whole lot. This is inventory as a nation. Ivy Zelman had said that overall our contacts feedback about activity thus far in July was surprisingly strong, with many brokers reporting robust start to the first of the year. So we know that really housing has not slowed down a great deal, specifically here in Oregon. As we look at listings, we know that listings as a nation has gone down, and it really has stayed down. January, February, it started to increase a little bit, but this report is from March until February. So, so really listings have gone down a little bit. We know here that there we go. Active listings dropped, again here. So we know that listings are starting to drop a little bit. The big thing is that here, as we look at house appreciation, now 2021 we had 18 to 20%. The average for the nation was 17.2% for appreciation throughout the nation. They're calling really for about 9-10% this year, 12% in that ballpark. So in 2022. Now, remember a slide earlier by the chief economist, of Freddie Mac, talking about how house prices are going to slow down a little bit. They're going to taper a little bit. That's the tapering. We can't consistently see that 18 and 20% without having a major housing crisis on our hands. But here we're looking at, we know that house prices are going to decrease a little bit. I'm sorry, they're not going to decrease. They're going to taper a little bit. So we're not going to see the amount of appreciation that we have. However, we're going to see still very strong appreciation rates. So as Goldman Sachs said here, we expect house price appreciation to normalize in 2022 and fall below trend in 2023. So that's really Goldman Sachs. We know that really a seller's market is when we have inventory less than 6 months on the market. Right now, we've got a month worth of inventory, a month and 1.2 months worth of inventory, depending upon certain areas here in the Pacific Northwest. We can have a couple of weeks worth of inventory. So we know that it's a seller's market. Now, this is really information from the National Association of Realtors. They're saying a neutral market is 6 to 7 months. Buyer's market is 7+ months worth of inventory. I'm wondering if this is really old data and it's really 3 months, maybe is 3 months worth of inventory is a seller's market. Has that changed a little bit? Now, again, existing home sales hit a record in 2021. It's expected to hit again another record here in 2022. So we know that the housing economy, the housing market is going to be strong this year. So it's a great year to sell. Now, as we look at really this, when you're looking specifically at rents, as you're looking at purchasing today, maybe waiting 6 months, because you're waiting for a bubble, you're waiting for something to break, you're trying to save up cash. I mean, whatever it is, you're waiting for 6 months. Remember that interest rates are going to consistently increase during that period of time. Remember that through that period of time, if you're paying $1,800 a month rent, and this is a great slide that I show clients to help them get off the table. So if you're renting and it's $1,800 a month in rent, you're really looking at purchasing today at $350, and your payment's going to be roughly $2,094 a month. Now, if you wait 6 months, if you have to wait 6 months, that house is, if it's gone up 7% in value. Now I know that houses right now have been going up 10% plus in value just over a 6-month period of time. But again, as we know that the market is going to taper a little bit, let's just say 7%. If it goes up 7% in value, that 350 house now is going to be 374.5. If it goes up 10% value, it's going to be worth 385. So one, the client loses out on the equity, but two, they're going to have to put more money down and more money into the transaction. Here we're looking at over that 6-month period of time, their payment is going to go from $2,094 to $2,319. And also their payment is going to go from $2,094 up to $2,429. Now there's a way to be able to really help to keep payments down. And I was going to talk a little bit about that in this show, but we've got another Lunch and Learn coming up here in April that Tracy and I are doing. And in that Lunch and Learn, I want to go really in depth instead of just covering it just really lightly right now. There is a way to be able to keep a payment down lower. And if you have a client that needs that now, I'm happy to talk to you one-on-one. But there's a way that you can either, buy down rate, buy out mortgage insurance. There's a myriad of different things that you can do to get that payment down, to back down to closer to that 2094. But the reality is that for most individuals, they're going to be paying more to purchase a home over the next 6 months. Also, you're looking at needing to bring more money into close. And so during that period of time as well, if you buy today, that 350 house, you're going to need roughly $26,000 if you're putting 5% down. And if you're, paying your closing costs, you're going to need roughly $26,000. It's going to go up to 27.4, so basically another $1,500 if you're waiting for 6 months. And if it goes up 10%, that's at a 7% rate. If it goes up 10%, you're really looking at almost $2,000 more that you have to bring to closing. Plus, again, almost another $300 plus per month that you're going to have to pay as well. So, so we've got that to battle up against as well. Really just want to open it up now at this point to any questions that you guys may have. There's a lot of data that we went through, a lot of statistical data. The reality, I guess, to put everything, I think I've done it, but to put everything kind of back into perspective, rates are going to go up. Values are going to consistently rise. They're not going to consistently rise at the value in which we've seen, but values are going to consistently rise. It's a great time to sell a house. It's a great time to buy a house. If your clients don't buy a house, then they're going to suffer not being able to have that hedge against inflation. Inflation is real. It is prevalent. It is happening. Gas prices are going up. The war is happening. This war is not going to be a quick war with Russia and the Ukraine. The economists that I'm looking at and the strategists that I'm listening to, they're talking about this being minimum 6 months, minimum, if not a lot longer than that. So that will start to change things as well when you're looking at rates and everything else. So all of those things, all of that pain that is happening is going to slide us into a recession. As it slides us into a recession, it's bad news for everybody else. But unfortunately, it's great news for us in this industry because that means that rates are going to go down. And as rates go down, then really 2022 being your best year yet can happen. 2023 being your best year yet could happen. We also know that really with housing, we're in a supply and demand issue with housing. And as we have that supply and demand issue, values are going to consistently rise during that period of time. And I had heard that really it was about 5 years left of this current market because we have the most first-time home buyers hitting the market over the next 5 years. And so I had heard, okay, great, it's going to be 5 years. Well, as I started listening to some economists talking about builders, they're talking about builders aren't going to be able to catch up really for about 10 years. So now they're calling for this market to be consistent for the next potentially 10 years. So we've got several years of really good stuff in our industry happening. It's going to be painful, but keep focused on your clients, keep focused on the good news. Stop listening to all the noise. Be that calm for your client. Be that voice of reason to your client, and clients will follow you. So thanks, Tracy.
Thank you. Tara has a question in the Q&A portion. So do you want to just read it?
Sure. Once appreciation goes below trend, is it expected? Let's see. Is the expectation then that house prices will then decline? No, no, we're not looking at, let me see. And let me just finish this. And then what
when that happens, are interest rates expected to be lower or higher?
So, yeah, so no, it's going to go below the trend of what we've had. That's what he was talking about. We're not going to see the trajectory that we've seen thus far, but it's going to go below that trend. So no, house prices are not, they're not expected to decrease in value. Again, because we've got that supply and demand issue, house prices are going to be consistent. We're not going to see the 18, 20% returns. We're going to get back down to more of a normal market. That's what he was talking about, really where we're seeing that 5 and 6% return, 4, 5, and 6% return. In Oregon, it was consistent really for about 4.5% for the longest time. And then we really spiked up. As we look at really a 30-year trajectory at this point, we're on a trajectory to be around, again, that 4.5, 5%. So great question. Any other questions, guys?
Nope. It's quiet in the chat with all that you covered.
Well, I think I put everybody to sleep because it is a lot.
I don't think so. I think there's a lot of good stuff in there.
So guys, you guys are going to have questions and you're going to be talking to your clients and you're going to be saying, what? Yeah, inflation. What did Walt say? just reach out. Here to be able to answer any questions for you guys, really help you with your clients. The thing that we work extremely hard on as a team is to educate, and we want to educate, educate you, educate clients out there. The sky, although the news would make you think that the sky is falling, the sky is not falling. Everything will be okay.
Yeah.
And everything that's going on right now was predicted, and it will happen, and it will continue to happen. Again, there's cycles in everything that we do. And so just ride through them. These things have happened in the past. They're going to happen again in the future. Ride through them. It's okay. We'll be okay.
That's the thing that really has hit me, that when I started selling real estate in 2005 and you're talking about the recession, and it was scary and it was hard and it sucked, but we all lived through it. So
yep.
Yeah, there we go.
And the thing is that people are starting to really go back to 2008, and I'm hearing, we're going to have a decrease in values again. And no, I mean,
This is
2008
different.
was a
Yeah.
great recession. It was, it was the Great Recession. 2008 was a 40-year dip that we have every 40 years. I mean, so it was already going to happen. It was just what pushed us in there. And it happened to be the housing market, happened to be,
Right.
the banks, the mortgage market. And so, and we also helped to pull everything, pull everybody out of that. But it was already predicted to happen. And so there is not, we're not going to have another one of those markets for another 40 years. I mean, we won't see it again in our lifetime, in this business, most likely. And
Mhm.
so really it's helping clients understand that. And as I know that as I explain those things to clients, they start to think, okay, well, maybe buying a house isn't a bad deal. As we show them really the rent versus, buy scenario, and the fact that those values are going to consistently rise, and you need to get into a house now, sooner rather than later. And, get a gift if you don't have a down payment. Get into a house somehow. Sellers aren't going to pay your closing costs. And so we're in a seller's market. We're not going to be out of a seller's market anytime soon. So but get into a house. If it's a house that you don't want to buy, well, get into a house, at least,
Make
if
a little money on it, sell it in a few years.
make a little money on it, and at least start getting that appreciation, as long as it's not a bad neighborhood. I mean, that you have to have a concealed weapons permit to live in. And so,
Right. Right.
make sure that your family's safe, of course. But if most of us, our first house was not our dream house.
Right.
So, and helping clients understand that. So I do that with statistical data. I do that with numbers. And then of course, you as realtors all deal with that on an emotional stance with your clients,
Right.
dealing on the emotional side. But again, 2008 happened. It happens every 40 years. It will happen again, but it's going to be in 40 years. And we're going to be out of the business by that point. Most of us will be. And so, but helping our clients understand that there's more first-time home buyers in the market now than there ever has been in the US. They're going to keep hitting the market for the next 5 years, more than there ever has been, consistently throughout the next 5 years. And then you've got now the builders starting to try to build as much as they can, but they've got supply chain issues and everything as well. And so, but you've got the builders that are going to really take this market potentially for the next 5 years past that. So home appreciation looks like it's going to be great for the next 10 years at least. But even if it was 5% appreciation, I mean, that's massive. That's absolutely massive. So, yeah.
Okay.
If you buy a $400,000 house and your house goes up 5%, then you made $20,000, right? I mean, $20,000, that's a third of most people's salary. And so, but you just made $20,000. If you paid 10% down on that $400,000 house, you invested $40,000, you just made $20,000. You made 50% on your money. I mean, what other investment can you invest in and make 50% on your money that first year?
Yeah.
So,
yeah. Okay. Awesome. Great information. I've got everyone's CEs ready to go out this afternoon. So, and we will be sending out the slides. So you guys are all good with that. Okay.
Perfect. Well, thank you. Thanks again, Tracy. Hope this information was valuable to everybody. It looks like it was from the comments. So thank you for attending.
Awesome.
If there's anything I can do, let me know. Anything you need from escrow, hit Tracy up. She's the master.
Thank you. We'll be putting something together for April for you guys. Thanks for hopping on with us.
Thanks, guys. Have an awesome day.
Bye-bye.